On today's Hashi, I'm discussing July's FOMC meeting minutes just released. Lennar is now turning to investors as unsold new builds pile up, and weekly unemployment report just released this morning at 8:30 a.m. Eastern Time. Today is Thursday, August 21, 2025. I am Byron Lazine, and the hot sheet starts now. Okay, live from Naples, Florida. Let me know in the live chat where you're tuning in from. Carmelo's hoping for positive news this morning. Carmelo, future is bright, my man. There's a lot of good things coming up. I think you got to know the reality of what's happening now. That's why we do the show every Monday through Thursday, 9:30 on the East Coast, 6:30 on the West Coast. It's the only 24-hour look back in the housing industry, in the housing market for housing professionals that exists on the internet. We do it every Monday through Thursday. The markets are open. The reality of what's going on so that we can be better equipped to have the conversations and be better prepared for a bright future that is undoubtedly coming. I love thinking. I was just having a conversation with James Dwiggins, CEO of Next Home. James Dwiggins has been doing a lot of keynotes over the last 12 months. As he continues to build up for the Raise launch. Raise, pretty cool piece of technology, helping agents categorize like an attorney, like all the things that they do for their clients. I was having a conversation with James yesterday, and I'm like, man, I think there's just so much to be excited for in the future. And there's so many conversations that are happening. Everything's kind of merging together right now in a big way. Technology shifts, big portal wars, all these different things that are changing. Yeah, a lot of economic changes. But to me, when I look at those that are keeping in tune to all the things that are going on, man, there's a really bright future ahead. Subscribe to the channel if you haven't done it. We do this live on YouTube, and then the replays are on Spotify or Apple. Best way to support what we're doing here at BAM is subscribe to the YouTube channel. It's the free and simple way. Okay, let's go. Let's get into this. We've got minutes from the Federal Open Market Committee. It's the FOMC. It's the committee that makes the decisions on what the federal funds target interest rate will be, the overnight rate, right? When the Fed, this is the minutes from the July meeting. So when the Fed makes a decision on the overnight rate, obviously that doesn't impact the 30-year. Now, the 30-year mortgage. Now it will over time. And the reason sometimes it doesn't happen overnight when they make a cut, impact the 10-year is because a lot of times the 10-year is pricing in where they think the Fed's going to go. Okay. 10-year starting today at 4.306. The 10-year is priced in now, over the last couple of weeks that we're leaning more closely towards a cut coming in the September meeting. CME Group, off of today's news, which we're going to get to, particularly with unemployment, CME Group has it at about an 80% chance. Now, we've seen this at 99% just like a week and a half ago, percent chance that the Fed will drop the rate. But it's at an 80% chance now. It's starting to slip a little bit. We'll see. Actually, let me just refresh this. It might have changed since even the jobs on 8:30. This stuff, this is a dynamic, 79%. This is a dynamic situation where as data comes in, it can change. The degens on Polymarket have it only at a 64% chance that there's going to be a 25 basis point cut. Obviously, I think right now what you're going to see is not much movement, even though we had an unemployment report that we're going to talk about here in a little bit. You're not going to see much movement until tomorrow. Tomorrow being Friday, speech from Jerome Powell out there in Jackson Hole. I can't imagine a better place right now to be. End of August, dog days of summer, than at the FOMC symposium in Jackson Hole, having some rosé. Jerome Powell's going to give some type of speech. Last year in Jackson Hole, the talking points from Jay Powell, based off of the symposium with the federal with the Fed committee that makes these decisions was, oh, we got a September cut. We're going to do a November cut. That was the message leading into a November presidential election. It's the only time since the restrictive policy from the Fed has been put in place that the Fed has cut is, we're going to start cutting right before the election. That's when they decided to do it. They still call this a restrictive place, and they're watching, obviously, inflation, so prices for consumers, and they're watching employment. That's the dual mandate from Congress. Now, if we dig into these minutes, it's an 18-page document that they release on their 2-day meeting. They do this a couple of weeks after, 2-3 weeks after these meetings take place. They do this every time they meet. So if we dig into, kind of what was inside here, we know that they obviously held the rate steady. It was the first time in over 30 years that multiple governors, remember, 2 governors voted against the rate decision of the committee. The rate decision was to hold the rate where they were. Christopher Waller, Fed Governor Christopher Waller, Fed Governor Michelle Bowman. Those were the 2 that voted against. Now, both of these names have been floated out there from President Trump and the current administration as possibilities to be the next, Fed chair. Remember, Jay Powell's up in May. Jay Powell was appointed back in Trump's first term. One person votes for the Fed chairman. It was President Trump voted for him by appointing him back in his first term. Biden reaffirmed him. So it's not like the public votes on who this person is. The person who put him in that position the first time now wants him out of that position. That person being obviously President Trump. So the irony in that obviously exists. So here's some of the notes here from the 18-page document, and then I'll get into some mentions of housing. The participants, so the FOMC members, highlighted risks to both inflation and employment. Okay, so those are the two mandates that they have. Okay, maximize employment, lower prices, or lower inflation down to the 2% target. And there's risks on both. The majority, though, judged the upside risk to inflation as the greater concern of the 2. Now, obviously, they made this decision before that recent big Friday, the Friday after they made the decision. I think it was Friday, August the 1st, that big job report that showed, hold on a minute. There's a huge revision here on job growth, and the job sector is not as strong as we thought it was. It was essentially the messaging from that big jobs report. We'll have another big jobs report before they meet in September. But, you got to believe that the committee knew that was coming. For them to be surprised by it 24 hours later, I wouldn't buy into that, personally. There were a couple, the 2 obviously that voted no, that saw the downside risk to employment as more pressing than the downside risk to inflation. Now, inflation has had some notable moves, recently that have been above expectations, but overall inflation has been moving to a, really sustainable place, getting closer and closer to that 2% target. The risks of inflation come more from the unknown of tariffs, even though Jerome Powell will say, I don't talk about tariffs, but he does talk about the uncertainty of tariffs impacting inflation. So he kind of does talk about it, even though he says he doesn't. The Fed minutes, inside the minutes, participants generally pointed to the risks of both sides of the committee's dual mandate, emphasizing upside risk to inflation and downside risk to employment. So this committee does not want to lower the rate from where it is. They want to keep it at this restrictive current state. Outside of the 2, and it'll probably be 3, obviously, shortly after that meeting, you had one member who resigned, and now, Trump's going to be able to appoint a new member. So probably going into the next meeting, you'll have at least 3 that want to go ahead and cut the rate. You might even have a 4th. Bill Pulte, the FHFA director, is the federal housing director, is working his tail off on X to try to get another one fired. Maybe I'll get into that. Maybe I won't. So if you're following that, it's all about mortgage fraud, right? Finding mortgage fraud is now the new thing for all these politicians to chase each other after. It's kind of interesting. President Trump's tariffs were central to the discussion. Participants cited uncertain effects on tariffs, the possibility of inflation expectations becoming unanchored. The Fed noted considerable uncertainty remained about the timing, magnitude, and persistence of tariff effects. So here's the thing. They don't want to be late, obviously, on lowering rates as it can impact the labor market. They also don't want to be too early and have inflation get. So right now, the MO has been like, let's just keep waiting, kind of sitting where we're at. Now, if you look at, I'm going to go to Nick Timiraos here on X. Nick Timiraos, Wall Street Journal, is, I mention him as being the Adam Schefter. If you follow the NFL, Adam Schefter's got he's got the phone number of every GM in the NFL, the owners and GMs that make decisions on rosters. Nick Timiraos, don't let him kid you. He's got the phone number of these Fed governors. He has a real feel for what's going on inside of the Fed. He put a post up on X here yesterday saying Jay Powell is under siege on multiple fronts. He's got political pressure right now with a whiff of institutional overhaul that goes beyond changing the chair. Okay. He's not going to give up that chair till he has to. He doesn't have to until May. That's at least what Jerome Powell has stated. There's pressure, though, from all angles to give up that chair early. Okay. There's not much of a belief that President Trump can go ahead and fire him and that the Supreme Court would let that go. There's supposed to be separation between the government and the central bank. Supposed to be an economy flirting with stagflation light or a slowdown is something else that Jerome Powell is trying to juggle. There are some signals that maybe stagflation is the thing that is brewing now. There's a committee now that is starting to splinter. First time since 1993, you had multiple Fed governors say, you know what, we need to cut, and went against the decision, whether it was cut or maintain or increase. So the first time since 93 that's happened. And you're going to see more committee members as they decide, I want to be in the favor of the administration that's going to be here over the next 3.5 years, as opposed to the favor of Jerome Powell, who's out in May. So the committee continues to splinter. Again, I mentioned Trump's going to have the ability to appoint a new member here with the member who has resigned, and you also have potentially a 4th on their way out with the pressure coming from Bill Pulte. So they commented on tariffs a lot here in the minutes, but Powell publicly doesn't comment on tariffs. Actually, I only comment on inflation. I'm the inflation guy. Inflation, the same inflation that Jerome Powell called transitory, back in the beginning, when it was quite obvious that all the money printing he encouraged the Fed to do was creating the inflation. Remember, inflation is created by the government, and we did that when we printed 80% of US dollar. Okay, here was an interesting Q&A, from Congress. We get elected by millions of voters. Those on the Hill, get elected by millions. You got elected by one person, and he doesn't want you to be in the job anymore. He's changed his mind. Okay. So this is the kind of pressure right now. This is the kind of pressure that Jerome Powell is. Somebody asked Jerome Powell recently, hey, you look like you're getting older. Like you're that Like if you look at Barack Obama from year 1 to year 8 in the presidency, or Bush or Clinton, by the end, by that 8th year, they all look a little old, like they've aged. They have 8 years, but they look like they aged 16. Somebody said to Powell, hey, like you're looking like you're starting to feel that presidential pressure here a little bit. You're aging maybe very quickly with all the pressure that's starting to mount on you with what's going on this economy. He said, no, I swim 3 times a week and I have a personal trainer. I'm good. He wants to stay. He's 72 years old. He said he doesn't feel worn down by the pressure. In fact, he says he's in the best physical shape of his life. Looks like a fit dude. He swims 3 times a week, works out with a personal trainer. And now he's enjoying life in Jackson Hole this week. So, I mean, hey, what could be better than Jerome Powell's? I wouldn't want to give that chair up until May either. Certainly not until after the symposium is done in Jackson Hole. So there's actually, and this is in Wall Street Journal, there is partisan political pressures. Okay. It's not just one side of the aisle that is calling for lower rates. Remember, we had a housing bill that went, through the committee, both sides, 24-0. That was bipartisan housing bill that is looking for affordable home solution. The fastest way you can get affordability in the buyer's hands is getting the rates to sustainably move lower. Obviously, you need to do that without inflation taking off. And obviously protecting the labor market would come with lower rates. So it's been 4 years where inflation has been above the Fed's 2% target. Obviously, when the Fed called inflation transitory, that was the time they should have acted, and we probably already would be out of this by now. But we can't go back in time and change that. And so, here you go. You've got a quote here from Diane Swank, chief economist at KPMG. There, meaning the Fed, no-win situation right now is what she's saying, because they're going to be late on employment, which we're going to get to here in a second. They're going to be late on employment no matter what. Okay, it looks like the labor market is continuing to softening, and no matter what they do, even if they cut in 4 weeks from today when they meet again, they're going to be late on employment. Diane Swank, chief economist at KPMG. This is given these downward revisions we've already seen. Expect more potentially, is what she's saying, downward revisions. And she's also saying, hey, inflation is going to look worse before it looks better, would be her take. So inflation is going to look worse, downward revisions on jobs. You're in that pickle. You've been talking about a soft landing for 4 years. Now you're maybe in between it a little bit, and you got to make the decision. What do you want to mess with more? Do you want to mess with, do you want to really get kind of what some see as being political and really waiting and seeing on tariffs, or is it the labor that you care mostly about? Labor will push the Fed to react. If you get a huge, loss of jobs on their hands, he will be remembered only for that and nothing else. Here's some of the commentary that we pulled from the minutes on housing. So they're talking about borrowing costs facing business, household, and municipality eased moderately, but remained elevated relative to GFC average levels. Consumer credit continued to be readily available for what? High credit score borrowers. So it's still difficult to obtain credit if you're a low credit score borrower. That would obviously include mortgages. The rate of serious delinquencies, we covered this recently here on either this week or last week on the high sheet. I think it was this week. The rate of serious delinquencies on FHA mortgages. So FHA is elevated. It is moving up. But when you contrast that against delinquency rates on most other mortgage loan types, those are all near historical lows. So if we look at the whole pie, the whole of Pete's, all right, you're not seeing delinquencies at any elevated level when you look at the whole thing. Okay. So regarding the household sector, several participants observed that a slower real income growth may be weighing on growth in consumer spending. That's one of those things we're watching for now. It's like, hey, can the consumer really hold up. The committee's take was housing valuations edge down, but remain elevated at where they're at. So what are they saying there? They're saying what they're always saying. We want home prices to go down. We don't care about home ownership, and we don't care about home prices. Fed doesn't care about either one of those things. They do not care if more Americans own home for the stability of their wealth and their future. Don't care about that. The Fed would prefer a renter nation and declining rents. And they do not care about home prices and home values. They'd prefer those to plummet. And that's their preference, because neither of those would align with their mandate of consumer prices and employment. So that's where they're at. That's the minutes there. We'll see what Jerome Powell says from Jackson Hole tomorrow. And we'll obviously break that down Monday on the hot sheet. All right. Before we get to the unemployment news of the day, which is going to be factored into investor decisions, and they'll probably couple that with what Jerome Powell's commentary is tomorrow before the market makes any big moves. But there was some news on unemployment released this morning. Before we get that, we'll jump into some of this Lennar news. National home builder Lennar, with our buddy over at Resi Club, Lance Lambert, says unsold completed new build inventory right now is so high that Lennar, $34 billion home builder, is now turning to investors. So Lennar, America's second largest home builder, just launched Lennar Investor Marketplace, a portal for mom and pop landlords to find deals from Lennar. Okay. It's so funny. If you, if you go into TikTok or Instagram or something like this, you can find an abundance of short clips from, younger folks who are now, they're now financial experts talking about how we need so much more inventory because, listen, millennials and Gen Z are never going to be able to buy a home. It's just not going to happen. Okay. And why is it not going to happen? Because we need more inventory. And then what do they say right after it? We need to stop all the investors from buying. And they're not just talking about institutional investors. They're talking about these mom and pop investors. Okay. You go down the rabbit hole of some of these non-capitalists on the internet. They're like, yeah, you shouldn't be able to buy more than one house, or you should get taxed through the nose if you're going to buy more than one house. Well, Lennar's sitting on a bunch of inventory. They're trying to sell it. And they're like, you know what? We're going to go to those investors who want to buy homes. We're going to go to the mom and pop. So public home builders sitting on a bunch of inventory, 10 months of inventory for the national home builders right now, can't sell it. Remember, new homes are less than existing homes. They're incentivizing it, making incentives. They're not only upping their incentive spend for home buyers. Hey, what do we got to do? Buy down the rate. Give you a new appliance package. Can we throw in closing costs? Can I send a masseuse over on closing day? They're also stepping up their offers to attract housing market's biggest investor group, which is mom and pop landlords. Listen, the institutional buyer doesn't own all the homes. They own very few of them. Mom and pop landlords, it's like 98, 97% of all investors are just mom and pop, just your neighbor, owns a few homes, rents them out, likes to make money. America's still a capitalist society. It's okay to make a little extra money, have a safety net going into retirement. I own 2 homes. I'm not giving them up. Okay. Look no further this week than Lennar now launching Lennar Investor Marketplace. The home builder, which has this $34 billion market cap, says that the portal is going to allow investors at any level to browse curated new homes and make informed, data-driven decisions. After creating an account, an investor can view Lennar homes for sale nationwide for the Florida build below Manatee County. The site displays Lennar's current offer at $499. So here's what it looks like. $499 is attractive for an investor right now. Hey, you get in under 5%. Go ahead and put a tenant into that property. I mean, this one here in Parish, Florida, $336,000. That's wow, that's a deal. The $336,000. I don't know what the rents are in this community. Obviously, the investor would know that. And here's what it looks like. The investor portal now targeting mom and pop investors to buy up some of this inventory. Here is the new completed single family new construction right now, just for Lennar. It's climbed to a 15-year high. They were sitting on 62,000 in June of 2018. Today, sitting at 119,000. The low point was clearly June 2021 at 34,000. So about a triple up, or more than a triple, about a quadruple up, I would say, a quadruple up from June 2021 to today on unsold but completed. There's nothing worse for a builder than having a house completed and just sitting there collecting dust. The sales rep is the only person that's going through it over and over and over again. Here's the industry. Okay. Or I'm sorry, here is the industry number of unsold completed homes for sale, highest level of completed unsold homes since July of 2009. That is definitely, we're talking about Jerome Powell feeling the pressure. Jerome Powell is feeling the pressure for sure, but who's feeling the pressure right now in real estate? Maybe nobody's feeling it more than these national home builders, and that's going to, have an impact on some of their employees. Obviously, certainly their sales reps. So Amy Nixon, who is, I would classify her as one of these doomers on X. There's a whole string of these that are always anything they can do to take a shot at the housing market. They do it. Amy Nixon at Texas Runner DFW. She's not as bad as like Darth Vader, but always looking to find a way to claim that housing is going to collapse. She posts this: a realtor whose clients toured a new construction home in the Dallas area over the weekend received this snippy follow-up text from an angry builder rep just hours after failing to return one phone call. The builder reps are struggling right now, she says, to meet sales quota. Don't doubt that at all. We saw where the builder confidence is, and people it's starting to get tense out there. Okay. Amy Nixon says this is strange behavior for a realtor, or she shares the text message. Okay. This is from the builder rep in Dallas to a real. This is strange behavior for a realtor. Not answering a phone. I would actually classify that as not strange, unfortunately. If your client is not interested, you should at least respond with a text or email. I went to my management on behalf of your client. These builder reps, I went to management for you. It's your job on behalf of your client to get extra incentives. You got the extra incentives because the house isn't selling. Okay. You didn't go and part the Red Sea. You didn't do anything that creative. You went and said, hey, I think I can get them if you throw in a freaking toaster oven. I got you extra incentives, and I've even reduced the amount of deposit money that we're going to take. Yeah, because you don't have another deposit in hand. You'll take anything. I could throw you $500 right now. Okay, and at the least you could do is respond to a phone call. I was a top producer. This is the old classic agent line who's been doing it too long. I was a top producer for years. And prior to being in new home sales, your behavior is exactly unprofessional. I just had to reply. The majority of in-house builder reps, I've met a bunch of them, not all of them. Okay, not all of them. Don't take me out of context. I said the majority of in-house national builder reps, they quit on professionalism years ago. They're not professional. They're now spending their days in model homes playing games on their phones, Scrabble, Wordle, whatever the flavor of the day is. And they're just being uncreative. You got a lot of uncreativity. You got some really good ones. out there, some top-notch ones. They're usually with a small custom home builder, not a natty, but they're typically being uncreative. I know this. I've seen a bunch of Pulte ones. They're down here, the ones I've met are very uncreative, pretty unprofessional. They claim they were all a top producer at one point, yet they made the decision to just stop all that success. Okay. Like, I was such a top producer. I decided I'd stop the success and go sit in a sales office. So, listen, you get good, reps for builders. You have smart ones, you have creative ones, but you have a lot that are looking for an easy way out. When times get tough out, you got to be creative. Okay. Just because you didn't get a response doesn't give you the right to blame everybody else. Like, what does Grant Cardone say? No response is a response. Guess what? They're not interested or they're looking at other homes because guess what? In your area, there's a lot of inventory. They're trying to make up their mind. They don't owe you a response. Obviously for relationships matter. I get it. Like if you want a relationship with that builder rep, obviously some kind of response from the agent, it is something that you can do there to build that relationship. I got no problem with high levels of communication. In fact, I prefer it, of course. But I've never danced around saying, oh boy, this agent didn't give me a feedback that I could share with my seller. They don't want the house. Well, why not? They don't want it. They don't want to live there. Okay. They didn't like it. They thought it was ugly. Okay. You want to know the truth? They thought it sucked. Right now, builders sitting on a whole bunch of inventory. And I think the tension until rates come down, even though they're buying these rates down, until rates come down on the overall, because that's what's going to get more flexibility in the market, more sellers to come to come off the sidelines and they become buyers. Until you get the overall rate to come down, builders are going to be in this tough spot. And you got a really bifurcated market. Okay. The Northeast not experiencing what's going on in the rest of the country. Northeast is starved for inventory. That's particularly where you need inventory, yet all of it's sitting down here in the Sun Belt states, Florida and Texas in particular. Okay, so there you go. There's where Lennar's at. They're trying to be, hey, if their sales reps aren't going to be creative, we'll be creative. We'll set up an investor portal and sell direct to investors. Okay, news of the day. This comes from the Department of Labor. In the week ending August 16th, the advanced figure for seasonally adjusted initial claims comes in hot, 235,000. It's an increase of 11,000 from the previous week's unrevised level of 224,000. It's a 4-week moving average now of 226, so it doesn't bump that up all that much. But this is something now to keep an eye on. Remember, there's be 4 of these weekly unemployment reports before the next meeting. Or at least 3 more, because the meeting's in 4 weeks, so I guess 3 more. And this one now comes in at 235,000. We've seen these moments where it pops up to 235, goes back down, pops to 240. But are you going to get 2, 3, 4 consistent weeks of maybe going into 240 and closer to 250? Remains to be seen. But unemployment coming in a little higher than what we've seen in recent weeks. Coming in at the 235K level. The 10-year's up 4.328. So 10-year in anticipation of tomorrow's commentary from Jerome Powell is up closer to the high watermark of the last 30 days. So inching back up here as the market starts to get less hope that we're guaranteed for a cut in September. The 30-year moved up a little bit yesterday to 6.61. That's the reality of where we're at here as we head into this Thursday and, of course, the weekend. All right. There you go. That's your update for the hot sheet here today. If you want instant access to all the content drops that we do, including Friday's content drop, every Friday we release new content, whether it be email, video scripts, all of the social posting, as well as your blog scripts or your blogs written for you. just jump into BAMX on school.com/BAMX. All the slides from every hot sheet I post here as well. So you can get all of today's data and hot sheet show notes inside of the classroom on School for the hot sheet, as well as all of our on-demand courses, including BAM board member Sharon Srivatsa's Knowledge Bank, just uploaded there as of recently. Next week, we'll have live members-only role play on Tuesday, and then on Wednesday of next week, we'll have Chris Benjamin going live for the community as well. So school.com/BAMX, jump in there. And I think yesterday's update was 7 tickets, might be less right now. I think 7 tickets left for the only in-person BAM event of the year. It's September 24th in Scottsdale. So we'll be sold out before September. A lot of times people are like, oh, I'll just buy a ticket the week before an event. I just want to mention, if you're thinking about BAM Camp Scottsdale, like, you're not going to be able to buy a ticket in September. Sorry. I think there's 7 left. The VIP experience and the morning mastermind are already sold out. So there are a handful of main event tickets left in Scottsdale, September 24th. If you've been thinking about it, just want to make sure I give you the opportunity there to grab that. That's bamcamp.live to grab that. Pat loved the Taylor Swift content last week. Hey, Eric and the team are just like super, obviously culturally relevant, timely with the content. Nobody has better content, obviously, than BAMX. And there isn't another agent community that'll help you close more deals like BAMX. School.com/BAMX. Pat, glad you loved it. Sounds like you're a Swiftie. I've become a Swiftie. I got 2 girls, so you got to be a Swiftie in today's day and age. All right, there you go. There's your hot sheet. See you guys. Knowledge Brokers pod tomorrow, separate channel. Walk through today, this channel, and I'll see you on the hot sheet Monday. Until then, toodaloo.